stop everything you're doing right now. What I'm about to show you could be the difference between retiring comfortably at 55 or working into your 80s, struggling with rising healthcare costs and shrinking pensions. Let me introduce you to two people. Sarah and Mike. They're both 30-year-old teachers earning $60,000 a year. They each decide to invest $500 a month, but they make very different choices. Sarah chooses a low-cost index fund. Mike, he goes with a popular, actively managed mutual fund. Over the next 30 years, they keep investing consistently. No gambling, no trading, just disciplined monthly investing. Fast forward to retirement, Sarah has $1.2 million, Mike has $700,000. That's a $500,000 difference. All from a single decision, the type of fund they chose. And it gets even more jaw-dropping. If Sarah had access to one of the top-performing hedge funds, her portfolio could have hit $3 million. And if Mike had simply chosen a diversified ETF strategy instead of a mutual fund, he'd have over $1.5 million. In this video, I'm going to break down exactly how different investment funds work. We'll cover index funds, mutual funds, hedge funds, and ETFs. I'll walk you through when to use each one and, more importantly, which one could potentially make you the most money based on your situation. By the end, you'll understand more about investing than 95% of the population ever does. And stick around, because later I'll reveal the one fund that I believe offers the best combination of growth, income, and flexibility. It might just surprise you. Let's get started. What is a fund? Explained with pizza. Let's keep this simple. Before we compare fund types, you need to understand what a fund even is. Imagine you and 9 friends want to order pizza. Each of you could buy your own small $10 pizza. That's $100 total. You'd each get one topping, maybe a drink if you're lucky. But what if you all pooled your $10 together? Now with $100, you can order 5 large pizzas with all kinds of toppings, a couple of 2 liters, and maybe even dessert. Everyone gets more variety, better value, and a more enjoyable experience. That's exactly what a fund does. Instead of trying to buy a few stocks on your own, which can cost thousands and requires research, time, and honestly, nerves of steel, you pool your money with other investors. That fund then spreads your money across hundreds or even thousands of assets. Whether you invest $100 or $10,000, you get a proportional slice of the same diversified portfolio. It's financial collaboration at its best. Number 4. Index funds, the backbone of smart investing. Index funds are simple, elegant, and honestly incredibly powerful. They don't try to beat the market, they just match it. Think of them like a mirror. Most index funds track a market index like the S&P 500, which includes the 500 largest US companies. This list includes heavyweights like Apple, Microsoft, Amazon, Nvidia, and yeah, even more. The magic? It's cheap and effective. Okay, so why do index funds actually work? Well, first off, they have really low fees. Most of them charge somewhere between 0.02% and 0.20% per year. So, on a $10,000 investment, you might pay just $2 to $20 a year. Now compare that to a typical mutual fund where you'd shell out $150 or even more. Plus, there's no human bias involved. There's no manager trying to outguess the market. And when it comes to long-term performance, over the past few decades, index funds have actually beaten the majority of actively managed funds. Let me give you some real numbers. The S&P 500 has returned about 10% annually on average since 1928. That means your money doubles roughly every 7.2 years. With those low fees and no trading gimmicks, index funds really let compounding do the heavy lifting. Now here's a real-world comparison. In 2007, Warren Buffett made a $1 million bet that an S&P 500 index fund would outperform a basket of hedge funds over 10 years. And guess what? He won. The index fund totally crushed the hedge funds, so this just goes to show how simple often beats complex. Of course, there are some downsides. You can't buy or sell index funds during the day. You can only do that after the markets close. Still, for 90% of investors, index funds are really hard to beat. Now let's talk about mutual funds. This is what Mike chose. Mutual funds are managed by professionals, analysts with MBAs, decades of experience, and expensive suits. Their job is to pick the right stocks and beat the market. Sounds great, right? Except, the problems: high fees. Mutual fund fees typically range from 1% to 2% annually. Some even hit 3%. Underperformance. Studies from Morningstar and SPIVA, which stands for S&P Indices versus Active, show that over 85% of mutual funds underperform their benchmark index over 15 to 20 years. Tax inefficiency. Mutual funds often distribute capital gains at year-end, meaning you may owe taxes even if you didn't sell anything. So let's look at a real example. If you invest $500 a month for 30 years in a mutual fund with a 2% annual fee, you'll likely end up with $500,000 to $600,000 less than if you'd used an index fund with a 0.05% fee. That's really the power of compounding fees. They don't seem like much at first, but over decades they can really drain your growth. Some of the big names in mutual funds include American Funds, Fidelity, and Vanguard. For some people, especially those who want a hands-on manager and don't mind paying extra, mutual funds may still have a place. But the data shows they're generally less effective than index funds. Number 2, hedge funds, elite access, elite risk. Now, we enter the world of hedge funds. This is where Wall Street legends and billionaires play. So you can't just sign up to invest in a hedge fund. You actually have to be what's called an accredited investor. That means you need a net worth of at least $1 million, not including your home, or an income over $200,000 per year for at least 2 years. Why the barrier? Well, it's because hedge funds take risks that, honestly, most people just can't handle. The strategies that hedge funds use, well, they include things like short selling, leveraging borrowed money, trading options and derivatives, and even investing in stuff like crypto commodities, fine art, or believe it or not, farmland. Some famous examples? Renaissance Technologies, for instance, averaged 66% returns annually in its medallion fund, though it's only open to employees. Then there's Bridgewater, run by Ray Dalio, which manages over $100 billion. And let's not forget long-term capital management, which actually lost $4.6 billion in 1998 and almost tanked the global economy. So, let's talk about fees, because, well, they're kind of painful. Hedge funds often use what's called 2 and 20. That means you pay 2% of your assets every year, plus 20% of any profits. So if your hedge fund makes you 10%, you actually keep only 8%. But here's the kicker. If it loses money, you still have to pay that 2% management fee. Should you invest in hedge funds? Honestly, probably not. Most hedge funds actually underperform the S&P 500 after you factor in all those fees. They might sound exciting, but when you look at the numbers, the costs and risks just rarely make sense. And now let's talk about the number one option, ETFs or exchange-traded funds. These are honestly the king of modern investing. ETFs really combine the best of all worlds. Like index funds, they offer low cost and broad diversification, but like stocks, you can trade them anytime the market is open. And here's the kicker. ETFs are generally more tax efficient than mutual funds, which means you could end up paying lower taxes. So let's talk about fees for a second. ETFs often have annual fees as low as 0.03% to 0.10%. And, many brokerages now offer commission-free ETF trading, which is a huge plus. As for variety, there are actually over 3,000 ETFs on the market. Some examples: for the S&P 500, there's SPY, VOO, and IVV. If you're into tech-heavy funds, QQQ tracks the NASDAQ 100. For international exposure, you might look at VXUS or IGZIS. There are also sector-specific ETFs like XLF for financials and XLV for healthcare. And if you want something more thematic, there's ARKK for disruptive innovation, or BITO, which is a Bitcoin ETF. Now, let's look at a real-life example and go back to Sarah. If she had invested in VOO, which is a low-cost S&P 500 ETF, at $500 a month for 30 years, with an average 10% return, she'd end up with around $1.14 million. And if she did the same thing in a diversified ETF portfolio, mixing US, international growth, and dividend ETFs, she could potentially end up with even more, plus some extra income along the way. So ETFs are, liquid, diverse, and accessible. Final thoughts. How real people build real wealth. Let's bring this full circle. Sarah ended up with over $1 million. Mike, just $700,000. So what's the difference? It's not really about how much they invested, it's about what they invested in. The key to wealth isn't chasing returns or trying to time the market. Honestly, it comes down to a few things: consistency. Invest every month, no matter what the market is doing. Low fees, index funds, and ETFs can save you thousands over the long run. And discipline. Ignore the hype and just focus on what works. By now, you understand how the 4 major fund types work. You've seen real-life examples, industry stats, and how fees, access, and performance can really impact your results. And now, well, it's your turn to choose. Are you going to be like Mike, paying for performance that never actually shows up? Or are you going to invest smart like Sarah and let time, discipline, and compounding do the heavy lifting for your wealth? If you're ready to take the next step, just click on the next video where I break down ETFs versus individual stocks and reveal one of the biggest mistakes investors make. Thanks for watching, and as always, stay invested.